Good evening, everyone, and welcome. Really glad you could join us tonight. What we're going to focus on tonight is helping you understand how buying a home actually works in today's market. We'll talk about things like what's really happening with affordability, common myths buyers hear about down payments and credit, strategies buyers are using to successfully purchase homes today, tips for both first time buyers and move up buyers, and some of the biggest mistakes people make that are easy to avoid. My goal tonight isn't to sell you anything, it's simply to give you clear information so you can make good decisions when the time is right for you. So let's get started. For those of you who don't know me, my name is Matt Adkins, and I've been in the mortgage lending world for over 20 years, and I've helped hundreds of families buy or refinance homes. I'm currently licensed and do business in both Texas and Florida. What I've learned over the years is this: people don't lose money in real estate because they made a bad decision. They lose because they didn't have good information when they made that decision. So my style is very straightforward. I believe in transparency, realistic expectations, and making sure you understand your options before you ever sign anything. This webinar is designed for two types of people. First-time homebuyers who are asking, do I need 20% down? Is my credit good enough? Should I wait for rates to drop? And for current homeowners who are thinking, I have a 3% rate. Does that even make sense to move? Or how do I use my equity? Or what would my payment actually look like if I upgraded? If you fall into either of those categories, you're in the right place. So, quick question in the chat, type first if you're a first time homebuyer, or move up if you already own a home and are thinking about upgrading. All right. So, let's be honest, the market feels confusing. You'll hear things like rates are high, prices are high, just wait until next year. But here's the truth: most people who are waiting don't actually know what they're waiting for. They're waiting for a headline. Tonight, I want to help you understand what actually impacts your monthly payment, what matters more than rate alone, and how to decide based on math, not emotion or news clips. By the end of this webinar, you'll know what you can realistically afford, mistakes buyers can make if they aren't properly advised, down payment myths and what you actually need saved, what rates look like currently versus historical norms, and what loan options exist and whether buying makes sense for you. And I promise there will be zero pressure tonight. My goal isn't to get you to buy a house tomorrow, it's to help you build a smart plan. So let's start by talking about what's really happening in today's housing market and why the numbers might not be what you think. All right, let's zoom out for a second. If you turn on the news or scroll through your social media or talk to friends, you'll hear one thing over and over: this market's crazy, or rates are too high, you should just wait. But here's what I want you to understand: the market isn't crazy, it's just different. And different doesn't mean bad, it just means the strategy has changed. So, first, let's talk about rates. I get this question all the time. A lot of people feel like rates are high. I mean, if you look back over the last 30 years, today's rates are actually much closer to the long-term average than the historical lows we experienced during 2020 and 2021. Those 2 to 3% interest rates were not normal. They were actually emergency level rates during a global shutdown. Those years were an outlier in history and definitely not the norm. So if you're comparing today's market to that small window of time, it will always feel very expensive. But if you compare today to the long-term average over decades, we're much more in line to the historical norms. So the real question for buyers isn't, will rates go back to 3%? Because that was a once in a generation environment. It's, how do we buy smart in today's market? Now, here's what's interesting. Because rates moved up, a lot of buyers stepped to the sidelines. And so that means currently there are fewer bidding wars in many price ranges, which makes for much more negotiation power by potential buyers. Seller concessions are back, and that's a big one. We'll cover that in a little while. But these can be huge for buyers that may need help paying for some of the costs associated with the loan. Temporary and permanent rate downs are common again, meaning you could have a seller pay to get your rate lower. And lastly, homes are sitting on the market longer in a lot of areas. In those years where we saw those low 2 and 3% rates, many there were so many buyers in the market, sellers had all the power. In a lot of cases, a buyer had to offer more than the asking price just to win the deal. In other words, buyers have leverage in ways they didn't have 2 years ago. So let's talk a little bit about your monthly payment. I think this is where I see the biggest misunderstanding. Most buyers focus only on the interest rate, but your monthly payment is actually made up of four different parts: principal, interest, taxes, and insurance. And then some places charge an HOA. The rate affects only one part of the equation, but the purchase price, however, affects everything. And this is why trying to time the market gets actually really tricky, because if rates drop, competition increases. And if the competition increases, prices rise. So the strategy shouldn't to be to predict the market. It's to understand your numbers and make a good decision based on math, not headlines. So let's look at this example. We have a home with a purchase price of 400,000 and an estimated market rate of 6%. The monthly payment on this is approximately $2,398. Now, let's say you want to wait until next year when you think rates are going to go back down into the mid fives. When that happens, just like you, other buyers are going to start to enter the market and drive the prices higher. Now, let's say that same house increases in value by $30,000 due to higher demand and normal market appreciation. The monthly payment on that same home at a 5.5% rate actually is higher than the same home now at 6%. But here's the kicker. Not only is the payment lower now, but in this example, if you would have purchased that same house this year, you'd also have $30,000 in equity. So real estate rewards preparation more than prediction. The buyers who win long term aren't the ones who are perfectly timing the rate. They're the ones who buy when the numbers make sense for them. So in this section, I'm going to talk to the first time home buyers in the room. But before I do, those of you who have purchased before, don't tune me out. Use this time as a refresher on how to qualify. So for our first-time homebuyers, when you submit a mortgage application, this will allow you to start to understand what kind of budget you can actually afford. Some buyers can actually afford more than they think. Others will need to adjust their expectations to something a bit less. Once we know your budget on a monthly basis, then we can focus on how much you have saved for this purchase, or in some cases, how much you need to start saving. Once we know those two main parts of your budget, we can develop a game plan based on all the options currently available to you. Most first time buyers don't struggle because they can't qualify. They struggle because they believe things that simply aren't true. Having a consultation with a loan officer like myself will remove a lot of the uncertainty that surrounds your decision. Now, let's talk about a few of the incorrect things that I hear buyers tell me before they talk to a loan officer. So, myth number one, I need 20% down. That's absolutely not true for most buyers. There are conventional programs at 3% down, FHA at 3.5% down, and then there's VA loans where you don't have to have a down payment at all. The 20% number that everybody talks about is really about avoiding mortgage insurance, not necessarily about qualifying. Myth number two that I hear a lot: my credit has to be perfect to buy. And the reality is, most first time buyers qualify with their scores in the 620 to 680 range, depending upon the program. We also offer loans with scores as low as 540. So, in most cases, we have an option for you. And even if you're not there yet, the fix is often simpler than you think. What hurts buyers most isn't low credit, it's not checking in the first place. So, some of the other things that I'll hear are: I'll buy when I make more money, or I'll buy when rates drop, or I'll buy when I can save more money. But here's the truth: life rarely lines up perfectly. The better question is, are you financially stable enough? Not, is everything perfect? So let me simplify this a little bit. To buy your first home, you typically need three things: decent credit, stable income, and some savings. Not perfection, just stability. My old mentor used to say, a mortgage loan is like having a three-legged stool where credit, income, and assets make up each leg. If one leg is removed, then the stool falls over. And that's the same with mortgage loans. If you have great credit and a lot of money saved up, but no income, then we may not be able to qualify you. Same for having great income and a ton of money in the bank, but terrible credit. We may not be able to qualify you. Having a certain amount of each will dictate each person's buying power. So now let's talk about each of those legs individually. And so for this, we'll start with credit. When you apply, we're going to pull what we call a tri-merge credit report, or a tri-bureau credit report. So we're going to pull your Equifax, your TransUnion, and your Experian scores. We take the top score off and the bottom score off, and then we use the middle score. That's going to be what dictates all of the terms of your loan. Most programs are going to require a 20% minimum credit score, but like I've said before, some exceptions can be made on a case by case basis. Also, most down payment assistance programs and for USDA loans, those require a 640 score. The other thing I'll say about that in credit, and I get this question a lot, if there are more than one borrower on an application, whose score do you use? In reality, if there's more than one borrower on a loan application, we'll use the lower of the two middle scores for qualification purposes. Now on to the income part of the stool. So obviously we want to see employment stability. And that's why when you submit your application, you're going to be telling us your 2-year history from your employment. Now, ideally, we do want it to be in the same line of work, but it doesn't always have to be. So just because you might have changed careers doesn't necessarily mean that we can't help you. Now, most jobs are W-2 or salary. Those tend to be a little bit easier to be approved. But for those of you that are self-employed, what we'll need there generally is your last 2 years of tax returns. And it, depending upon how you file your taxes, we may also need to get your business or corporate tax returns. Having that said, if you've been in business for over 5 years, a lot of times we may be able to get away with just using 1 year of your tax returns. And that is what we would use to figure out your income. Now, some of you may have variable income, and this is going to include things like overtime or commission or bonus income. Those 3 types of variable income, we do need to show a 2-year history of it, mainly because by nature, those can go up and down over time. And so the Fannie Mae and Freddie Mac and FHA all require that we use a 2-year history or a 24-month average of that portion of your income to figure out how much we can give you. And that's also kind of the same for part-time work. Part-time work, we need to show a 2-year history of that part-time work, and then we take an average for the same reason. Some weeks you might work 25 hours, some week it might be 30. So what we do is we take a 2-year or a 24-month average of your income over that time period, and that's how much income we can give you. And the last leg of the stool would be assets, or the money you have saved up for a down payment and closing costs. So for that, we usually are going to ask for 2 months of bank statements. And the reason that we're asking for those is that what we're going to be looking for is any large deposits. Deposits from your employer, like from your direct deposit, we'll be able to use immediately. There are also other exceptions that we can use, like if you get a big tax refund. Generally, that's pretty easy to verify, and you can use that immediately. Or maybe you inherited some money. If we can document that that money came from an inheritance, you can use it immediately. Also, you can use stocks and bonds, and some people even take loans against their 401k to help them with their down payment. And those are all acceptable as well. Lastly, a lot of people, especially first-time homebuyers, get gifts from family members. And as long as that family member that's gifting you the money is willing to fill out what we call a gift letter, we should be able to use it. As long as that gift letter says that this is not a loan expected to be paid back and that it is a gift, then we can use it. And a lot, like I said, a lot of first-time home buyers allow for this, for parents or aunts or uncles, that sort of thing. So that now that we know what's needed to verify your assets, let's talk a little bit about how much you actually need. Here are the 3 main loan products we use and their required down payment minimums. So for conventional loans, which is probably the most popular loan product, if you're a first-time home buyer, you can do 3% down. If you've owned a house within the last 3 years, then you would actually need to do a minimum of 5% down. FHA allows for 3.5% down, and that's actually for anybody. You don't have to be a first-time home buyer to do 3.5% down. And then for VA loans, you actually don't need a down payment as long as you're an eligible veteran that has enough entitlement. But you may ask, how much total do I need? Didn't you mention something about closing costs? And I did. So I think this is really where clarity starts to matter. When you're buying a home, you typically have down payment, closing costs, and prepaid taxes and insurance. So obviously your down payment is going to be a function of the price of the house, usually 3 or 5 or 10 or 20% down. Next is going to be the cost associated with actually getting the loan. These are going to be fees like processing and the fees that you pay the title company for a title search and a title policy, an appraisal, and other third party services that we have to have in order to be able to give you the loan. And the third one, not a lot of people know, and they kind of lump this third one into kind of your overall closing costs. And that's going to be prepaid taxes and insurance. These are going to be an advance on the payments for property taxes and homeowners insurance. And here's the part that many buyers don't realize. And I mentioned it before, but seller concessions are back. In today's market, it's very common for sellers to contribute towards closing costs, which reduces what you bring to the table. A seller can't give you money towards your down payment, but they can pay for all of your closing costs. Let's use a simple example here. These are ballpark numbers, so keep that in mind. But let's say you were buying a home and the purchase price of it was $350,000. If you're a first-time home buyer and we do a conventional loan, you do your 3% down, that's $10,500. And closing costs are going to vary between 2 and 3%. So your total out of pocket at this point now is in the neighborhood of about $17,000 to $18,000. But if the seller contributes, your out of pocket drops significantly. So when buyers see the actual numbers, not scary guesses they have, things become much more manageable. So in this scenario, let's say you get the seller to contribute $5,000 towards those closing costs. Now, all of a sudden, your total out of pocket is reduced to $12,500. So here's the key takeaway from this section. Most first-time home buyers aren't as far away from buying as they think. They just haven't had someone walk them through the numbers clearly. All right, so moving on from the first-time home buyers, let's talk to all the homeowners in the room. I'm going to spend a little time on this slide because it's really important. Also, the first-time buyers in the room, this is good information for you as well, since one day you may want to buy a different home and will be in this same position. So if you bought a home or refinanced in 2020 or 2021, you probably have a rate somewhere in the 2 to 4% range. The thought of giving that up feels painful, and I get it. In the industry, we call this the golden handcuffs. But here's the question I want you to consider. And some of you may have heard this, but it's true. Are you married to the rate or to the house? A lot of homeowners start to feel stuck, but the rate isn't the full picture. You don't live in a rate. You live in a house. If your family's grown, if you need a better school district, if you're working from home and you've run out of space, the conversation really isn't just financial anymore, is it? It's lifestyle. Here's what a lot of homeowners don't realize. If you bought 3 to 5 years ago or more, you likely have a significant amount of equity in your home. That equity is your leverage. As a very quick example, if your home's worth $500,000 and you currently owe $350,000, that's $150,000 in equity that you have. You don't get all of that in your pocket after you sell because there are costs to sell, but you may have far more in buying power than you actually think. Now let's talk a little bit about strategies. So I hear this a lot. Should I sell first or buy first? I think this is where strategy really starts to matter. There are typically three approaches. So you can sell first and then buy. You can buy first and then sell afterwards, or you can keep the home and rent it out. Each option, I think, has pros and cons. And there really isn't a one size fits all answer for everybody, but there is a best answer for your situation. So what if you sold first? Selling first is definitely the safest strategy. You know exactly what you're walking into. You know your down payment amount. You remove all uncertainty. What's the downside? You may need temporary housing if you don't time it just perfectly. And that could be a struggle for people, especially in this market. What if you buy first? Buying first avoids moving twice, and that's a big one. But it requires strong income or the ability to carry two mortgage payments temporarily, or the need to explore things like bridge loans. Well, what if I want to keep it as a rental? A lot of homeowners ask me, should I keep my 3% rate and rent this home out? I tell you, that could be a great strategy, and I did it myself once, but only if the rent covers the mortgage comfortably. You can qualify carrying both properties, and you're prepared to be a landlord. And that's a big one. It's not automatically the best move, it's a math decision. Here's the key. Move up decisions shouldn't be driven by fear of losing a low rate. They should be driven by long-term math and lifestyle alignment. The goal isn't to protect a rate. The goal is to build the life you want responsibly. Now, let's talk about how to evaluate affordability in both of these scenarios. We'll bring this down to what really matters, the numbers, right? Not headlines, not opinions. What does affordability actually look like in today's market? So, your buying power isn't random. It's driven by four main factors: your household income, your monthly debt obligations, the amount of your down payment, and of course, your credit. That's pretty much it. It's not math. I mean, it is math, it's not magic. What this means is two families making the exact same income can qualify for very different amounts depending upon their debt and the way that they structure their loans. Using these four pieces of information, a loan officer like myself can determine what you qualify for and at what rate. So let's look at a couple of simple examples here. These are three different loan amounts, all at a 6% rate on a 30-year loan. At 300,000, your payment should be about 1,847 a month. At 400,000, the payment goes up to 2,463. At 500,000, it goes up to $3,079. But notice something important here. The jump between price points isn't always as dramatic as people assume. In this example, the difference in payment increasing the loan amount by a full 100,000 is only about $600 a month. So sometimes moving up in small increments like $25,000 to $50,000 in price changes your payment less than people expect. Now let's talk a little bit more specifically about down payment. Many buyers think they need a huge down payment to make a difference. But look at this. The difference between 3% and 5% and 10% down may not drastically change your payment. Sometimes keeping cash in reserves is smarter than draining your savings just to lower the payment slightly. So in this example, on a $400,000 loan at a 6% rate on a 30-year term, your monthly payment doing 3% down, the minimum, or $12,000, is $2,326. Now, if you move up and you do 5% down, go from $12,000 to $20,000, so another $8,000 out of pocket, your payment only goes down to $2,279. If you double that and go from $20,000 to $40,000, or 10% down, your payment only drops to $2,159. Now, one thing to note here in these examples, the payments you see are just the principal and interest portion of your payments. For conventional loans and for FHA loans, for a down payment less than 20%, you're going to be required to have monthly mortgage insurance added to your payment. And the amount you pay for that will be dependent on the type of loan you use, your credit score, and the down payment percentage you make. But this is a good example of at least just the principal and interest portion of your payment, what it can do based off of the down payment you choose. So I hear this one a lot too. Buy now and refinance later. For those that are buying now and aren't waiting for rates to go down further, this is the strategy they are implementing. This is also the strategy a lot of people overlook. So real estate is a long-term asset. If rates improve in the future, you refinance. If they don't, you're still building equity and you're controlling your monthly housing costs. But if prices rise and you waited, you don't get to go back and buy at yesterday's price. You'll be stuck paying the current market price. Rates can move down, but your purchase price is going to be locked in forever. One last thing on this before we move on. Just because you qualify for a number doesn't mean you should spend it. Affordability isn't necessarily what the bank or what I say it is. It's what allows you to sleep at night. And the goal isn't to max out your approval. It's to build a plan that fits your life. That's a great question. It does not factor into it because the assumption there is that your lease will be going away once you buy this new house. Now, if you still are obligated to pay it for a certain amount of time or you have to break that lease, that's definitely between you and your landlord, but it isn't necessarily something we have to factor in when we're trying to give you an approval. So we don't necessarily need to include the current housing expense or your current rent payment. All right. So now that we've talked about affordability and what a comfortable payment really looks like, the next smart step isn't guessing. It's getting properly prepared. Because the buyers who win in today's market aren't the ones who move the fastest. They're the ones who are the most prepared. So let me show you exactly what that looks like. These are some basic examples of things a lender may need in order to offer you a loan approval. So as we talked about a little earlier, if you're self-employed, we'll need to see your last 2 years of tax returns. If you are a W-2 or hourly or salary employee, we may need to see a 30-day pay stub or pay stubs covering 30 days. Sometimes we'll even need your W-2 from the previous year. For assets, we're going to need to see your last 2 months of bank statements. And I went ahead and put all pages in there because it's important that when we request things, if we get a statement that says page 1 of 4, we're going to need to see all 4 of those pages, even if the last page is blank. So keep that in mind. We'll need a copy of your driver's license and your social security card. And sometimes we'll need letters of explanation for credit issues or for large deposits or maybe even gaps in employment. Sometimes we have to tell the story to an underwriter to give them the full picture of what we're trying to do here. And for those of you that are veterans for VA loans, we usually will need to see a copy of your DD 214, or if you have your certificate of eligibility, that'll help too. I think this next slide is incredibly important. Once you're preparing to buy, there are a few things that can accidentally derail a transaction. I've seen it happen, and it's not fun. You're going to want to avoid things like opening new credit, making large unexplained deposits, changing jobs without a conversation with me, or buying big ticket items like a car or furniture. When in doubt, just ask first. A quick text or an email can save a lot of headaches. A couple of years ago, I actually had a lady that I was helping buy a house and everything was going smooth. She was well qualified. We got to 2 days prior to the closing, and I get a call from my processor. Come to find out, she decided to quit her job and start a new job. And after talking to her, she knew that she probably shouldn't do that, but she couldn't miss the opportunity and she was going to be making a lot more money, so she didn't think it mattered. And she even told me she didn't think we would find out about it. Well, what a lot of people don't know is that usually 3 to 5 days before we close, we have to call and verify things that are still the same that we approved earlier on in the transaction, like, do you still have your job? And when we did that for her, they told us she no longer worked there. Now, the end of this story ended up being fine because we were able to get an extension to the closing date, thankfully, and we were able to get the documentation we needed to use that new income. But had she told me that she was going to do that before, we would have been able to close on time, or maybe she waited a few days to make the change. So it's important that we be very clear and honest about those things, and that way we can help you avoid some of these pitfalls. If I could give every buyer 6 quick pieces of advice, it would be these. Get pre-approved early. I don't think it's never too soon to start those conversations, because if you're, a few thousand or a lot, away from buying your house, you want to know that now, and that way you can develop a game plan to get there. I do think that you should focus on the monthly payment, not just about the purchase price. Find out what you really can afford, because unless you've actually been doing this a while, when I tell you a $600,000 house has a certain payment and you think it was the same payment for, I don't know, a $300,000 house, that's going to change the math quite a bit. Third tip is keep your finances stable during this process, right? So again, that goes back to not making big purchases, keeping your income stable. Obviously, you get a raise at your job, that's great. We just don't want to see the other direction. Another big one, and this is especially big for first-time home buyers, maintain a healthy amount of reserves after closing. A lot of times, first-time home buyers save exactly enough to pay for their down payment and their closing costs. Now, all of a sudden, they own a house. And, oh my goodness, I have a yard. I need a lawnmower, or I need a weed eater. There are things, obviously, that if you've never owned a house before, you didn't know that you necessarily needed. And so a lot of times, if we can structure it in a way that leaves you some money afterwards, it's going to set you up for success being a new homeowner. Another one is don't try to perfectly time the market. Just get prepared to strike when the perfect house presents itself. And most importantly, work with an experienced professional who communicates clearly. The team that you assemble, which would be your realtor and your lender, to help you purchase your home can make all the difference in a stressful process versus a smooth and easy process. I think those 6 things alone prevent most home buying stresses. So hopefully tonight gave you a clearer picture of how buying a home actually works in today's market. At the end of the day, buying a home isn't about perfectly timing the market. It's about being informed, being prepared, and recognizing the right opportunity when it comes along. All right, we can open it up for some more questions. All my contact information is there on the screen, and we'd be happy to help you. If you have additional questions, I can set up some time for everybody to have some one-on-one, and I can answer any of your questions going forward. Because again, it's all about making sure that we can get you to get you set up for future success. Anyways, I hope all of y'all have a fantastic afternoon, and we'll see you next time.